Tech stocks are collapsing, with some of the best companies on earth going down by more than 20% in the last month alone. And whenever I see such a sharp decline, there's really only one question left to ask. Is this the end of the line for tech stocks, or are their best days still to come? Your time is valuable, so let's get right into it. First things first, I'm not here to hold you hostage, so here's everything I'll talk about up front. Why tech stocks are crashing right now, and how long this crash could last. I'll share some solid data that I always look at whenever I get worried about the market, and of course what I'm doing now that everyone is moving their money out of tech stocks. You've probably heard the saying, be fearful when others are greedy, and greedy when others are fearful. Well, for the first time in almost a year, CNN's Fear and Greed Index is showing extreme fear. But that doesn't mean that we should blindly buy stocks just because they're down, since they could have much further to fall. And to understand why, we need to talk about what's causing this big tech crash in the first place. The truth is, there's a lot of factors coming together to cause this drop. The first and most targeted reason is that recent earnings have underperformed analyst expectations, which in my opinion have reached insane levels. Here, check out this headline for Microsoft. Microsoft shares dip as cloud miss overshadows better than expected revenue and earnings. Revenues from Microsoft's cloud business, which includes things like Azure, Windows Server, and GitHub, grew by 29% year over year, but analysts expected 31%, so the stock dropped, even though Microsoft also outperformed analyst expectations for overall revenue and earnings per share. Here's another one. Alphabet meets earnings expectations but misses on YouTube ad revenue, which only accounts for about 10% of their total revenue. YouTube generated $8.66 billion in revenue, while analysts expected $8.93 billion, a miss of just 3% in Google's fourth biggest business unit, while their top three business units all beat expectations. Now, to be fair, there have been some very real issues causing certain stocks to drop. For example, Nvidia just delayed their Blackwell B200 chips because they found a design flaw unusually late in the production process. That's obviously bad, but regular viewers of this channel know that Blackwell got pushed up by a full year as Nvidia sped up their chip architecture cycle from 2 years to 1. That means Blackwell just went from being 12 months ahead of schedule to 9 months ahead of schedule. Don't get me wrong, a delay is a delay, but the pattern I'm trying to show you with Microsoft, Google, and Nvidia is that analyst expectations have gotten away from the reality of growing a technology business in a tough economic environment. So let's talk about that next. Last week, an economic report came out that showed job growth coming in much lower than expected, and unemployment rose to 4.3%, which is the highest it's been since October of 2021. While no one should wish for higher unemployment, one small silver lining is that the Federal Reserve looks at that number to help decide when it's finally time to cut interest rates, since higher unemployment leads to fewer people spending money, which drives down inflation. Not to mention that they might cut interest rates to score some political points ahead of the US presidential election this November, the results of which could have huge implications on the economy as well. But the problem is this sudden spike in unemployment triggered something called the SAM rule, which states that the economy is in a recession when the 3-month average unemployment level hits half a point higher than the 12-month low. And while this SAM rule has predicted every major recession going back to 1960, it's one of those indicators that was created to fit the data, not the other way around. Its creator, Claudia Sahm, a former economist for the White House and Federal Reserve, even came out and said that the rule might not apply here, and this time really could be different thanks to growing household incomes, along with resilient consumer spending and business investment. But that didn't stop recession fears and headlines from spreading like wildfire. But how bad are things really? One of my favorite pieces of investing advice is when in doubt, zoom out. The Nasdaq is down by 12% over the last month alone, but it's still up by almost 9% so far this year. And Nvidia has collapsed by over 20% in the last month. Oops, except it's still up by 110% this year alone. But let's pretend that this isn't a normal, healthy correction for tech stocks. Let's pretend that it really is the start of a big recession and a bad bear market. Instead of letting emotions guide our decision making, let's use cold, hard data. Just a quick note, a dip or a pullback usually indicates a decline of less than 10%. A correction is a drop of more than 10%, but usually less than 20%, and a crash is a decline of 20% or more. So, for example, the Nasdaq is currently in a correction, while Nvidia stock is crashing. Alright, here's a chart of every bull and bear market since 1956, with the recessions shaded in gray. On this chart, a bear market is where the market crashes by 20% or more from the peak, and a bull market begins from the stock market's bottom. Here's some interesting data points for long-term investors to consider before panicking. First, bull markets last much longer than bear markets, and they rise much higher than bear markets fall. The average bear market lasts for about 1 year, peak to bottom, and the average depth of a bear market is 36%. A bear market recovery, which is where the stocks make a new all-time high from the bottom, takes about 2.5 years on average. That sounds scary, but remember, it's only 2.5 years if you bought at the exact top right before a full-on market crash. That's why it's so important to be patient and not catch a falling knife. Waiting even a little bit can massively reduce your downside. And even if you do miss the exact bottom, there's a huge 2.5 year recovery window on the other side. And corrections, like the one that we're in right now, are much softer than crashes. The average depth of a correction is just 14%. It only takes 5 months on average to reach the bottom, and just 4 months on average to recover. Also, corrections have happened every 1.2 years since 1980, which means they're actually pretty common. In fact, there were 5 separate stock market corrections in 2020 and 4 in 2022. And that's just for the S&P 500, which is considered one of the safest and most stable indexes to invest in over the long term. You may not realize this, but around 2/3 of professional, active, large-cap fund managers and analysts underperform the S&P 500 every single year. 80% of them underperform over 3 years, and virtually none of them beat the S&P 500 over any 5-year period. All for one simple reason. They're people just like you and me. They make decisions based on emotions, they cut corners when it comes to research, and they consume the same CNBC, Bloomberg, and Yahoo Finance clips that we all do. Even worse, their jobs require them to hit performance milestones every single quarter to justify their fees, so they're forced to think short-term, not just long-term. And the truth is that it's easy to say that you're a long-term investor when the market is going up, which I just showed you is most of the time. But what separates the champs from the chumps is how they handle downturns. Here's a chart I made for a video back in April, but it applies even more today, and I'll show you why. By the way, this is before Nvidia's 10-for-1 split, so just pretend the price says $82.50 instead of $824. You've heard this story 1,000 times before. If you invested $10,000 in Nvidia when it went public in 1999, your money would have grown by 1,000-fold to be worth over $10 million in 2024. That's a 32% compound annual growth rate for 25 years straight, absolutely crushing the returns of the S&P 500. And remember, even though Nvidia stock is down by 20% over the last month, it's still trading at over $100 per share. So your $10,000 from 1999 would actually be worth around $12 million today if you could have held it that long. I've been holding Nvidia stock for over 8 years, and it's been one of the most difficult things I've ever done. Here's another version of Nvidia's price chart, except this time it shows you the drawdowns. The top of this chart is 0%, which means Nvidia stock is at a new high or 0% off the peak. Everything below 0 shows how far it's dropped and how long it took to recover before making a new high. Said another way, this chart shows every dip, correction, and crash that Nvidia has ever had. So let's count them up. Nvidia stock has corrected by 10% or more 31 separate times. That's once every 10 months on average. It's crashed by 20% or more 18 separate times, not including this one. That means Nvidia stock has a full-on crash every 17 months on average. It's crashed by over 30% 11 of those times, which means it had to recover by almost 50% to reach a new high 11 times. 5 of those times it actually crashed by 50% or more, which means it had to double every time just to break even. And it straight up collapsed by 80% twice, once during the dot-com bubble and again during the financial crisis of 2007 and 2008. And it gets even worse when you look at how long the deepest crashes took to recover. If you invested in Nvidia at the top of the dot-com bubble, you saw the stock go down 85% over the next year, and 2 years later, you were still down by 80%. It took Nvidia over 5 years to recover, just in time for the global financial crisis, where Nvidia stock fell over 80% again, except this time, instead of recovering after 5 years, it was still down by around 70%. It ended up taking 9 years for Nvidia stock to make a new high. 9 years. My point is, these two price charts are actually the same chart, which means investors can't get the insane returns in the top chart without surviving the volatility in the bottom one. Nvidia stock is down by 6% today as I'm recording this video. That means it lost more value today than all of Intel is worth as a global company. I promise you that most professional money managers and stock market analysts aren't able to hold through this kind of volatility, even if they had the stomach for it. Their bosses wouldn't let them because they have quarterly numbers that they need to hit. But don't forget, volatility swings both ways. Just last week, on July 31st, 2024, Nvidia stock had its single best day ever. It added a whopping $329 billion in value, going up 13% in one day as a $3 trillion company. Alright, I've covered several reasons why tech stocks are crashing right now, from earnings underperforming very high analyst expectations, to the unemployment rate triggering the SAM rule and the Federal Reserve starting to signal interest rate cuts in the near future. I also gave specific examples of why those things don't bother me, and I showed you historical data on the depth and length of corrections and crashes for the S&P 500, as well as Nvidia stock. Now that we're on the same page about the context, let me tell you what I'm doing now that everyone seems to be moving their money out of tech stocks. And if you feel I've earned it, consider hitting the like button and subscribing to the channel. That really helps me out, and it lets me know to put out more content like this. Thanks, and with that out of the way, here's exactly what I'm doing now. The first thing I'm doing is building my cash position. I actually started building cash back in June when I sold about 1/3 of my Nvidia position at just over $130 per share. I'll leave a link to that video in the description for you. That's a good one to watch next because I share some investing rules that I use to get rich without getting lucky. Second, I'm concentrating my portfolio down to just my core holdings, the NASDAQ 100, SMH, the big 3 hyperscalers, and a few other companies I cover often on this channel. As everything goes on sale, I want to be more picky with what I buy and when I buy it, not less. I still have some of my small cap stocks from a few years back, so now might finally be the time that I take my losses, depending on what's happening with interest rates. What I'm not doing is rotating my money into any other kind of stocks. I'm doubling down on AI, semiconductors, and the ecosystem behind them. I strongly believe that this AI boom is real, and we'll see stocks like Microsoft, Google, Nvidia, and Palantir make new highs in the near future. So I'm going to keep researching and covering these companies even as prices fall. Remember, the key to finding great stocks is understanding a company's products, not just their profits. So whether this is a small correction or a full-on crash, there's never been a better time to understand the science behind the stocks. Thanks for watching, and until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.